All right, all right. Hey, hope you are doing well. Got a number of things that we want to talk about, kind of importance of what's taken place, kind of a trifecta, if you will. What took place, with the Fed rate meeting where they held rates, what took place recently with the job reports, and then also what took place with inflation. So you got this trifecta. So, of course, everybody knows that the Fed held rates. We had shared that that was the expectation in the case. They have the upcoming meeting in March. And again, they're signaling that that's the intention, that, maybe their best case is one more rate cut for this year. Now, that could change, though. And, here's the mixed bag that's going on. What you see is that you also see that the jobs report came out with 143,000 jobs created, which was kind of blew away everybody's expectation, dropped unemployment to, I think, about 4.3%. So again, that's a positive thing, meaning that the job front and the economy is moving forward. We also saw previously the strong GDP numbers that came in for the previous quarter that, Trump was expressing and touting as well. So you've got this underlying improvement, if you will, in the economy. And I know it's kind of a mixed bag. It's like what you call a K recovery, where the folks at the bottom are not really experiencing much in the way of recovery. And then the people more in the top category are getting more, upside, so to speak, people with assets, people in the stock market, that kind of thing. So then you also take a look at the inflation report that came out that hit at 2.4%, which was much lower than expected, and also tracking and moving towards, the Fed's kind of still quote unquote target of 2%. So it puts them in a mixed bag, because if you've got employment cruising along and job creation cruising along, there's not a lot of reason to look at cutting rates. Now, with the lower inflation, the bond market responded with about a 20 basis point drop on the 10-year Treasury, because if inflation is sustained at a lower pace, then it's likely that longer-term interest rates are lower, thereby more money rotates into, bonds to go ahead and take advantage of that rate now. And that further raises the price of the bond and reduces the overall interest rates. And so that's what we saw take place as well when the inflation numbers came out. I think, again, what we have said for, 2 years now is, looking at this data and this information, it is a greater likelihood that the interest rates are going to stay higher for longer, meaning we're going to be in this channel where interest rates are in a more higher sustained pattern. I know people had been saying, well, the Fed's cutting rates, and look, they've already cut rates and it hasn't really reduced the bond market, because the bond market is driven more by supply and demand. It's driven by what the government's doing with issuing debt. It's driven by how other countries, evaluate our currency, and then also, the credibility of our bond payments, et cetera. The one thing I think that a lot of people aren't talking about is, if you go back and you look at inflation, you look back in a period like 80s and 90s, you had globalization taking place. So meaning cost of goods and services went down, because a lot of that stuff was being shipped overseas, and China was a big, factor of that's what took place. So those reduced cost inputs helped keep inflation lower. And then you look what took place in the 2000s, you had the implementation of the internet, and that really made a global impact as well for companies to be able to communicate better, streamline. I mean, there was a lot of economies of scale and benefits that took place as a result of the, infrastructure of the World Wide Web, the communication improvements, just all the streamlining that's happened. The thing that's happening now that's really not talked about is AI, right? So what is the variable there? Because you already start to see strong and significant improvements in what companies are doing. KPMG, they just did their, call, said on their earnings call, they said that they had a 30 to 40% margin improvement because of what's taking place at AI. And then, reportedly, one of their largest clients said, hey, man, we want a reduction in fee by 25%. We were on the call. We saw what's taking place with your numbers. Salesforce, half of their calls are being implemented by AI for their customer service calls. So these are all things that companies in the immediate near term and over the next 2, 3, 4, 5 years are going to be benefiting from. Our single family team, we already have AI answering calls and interacting with people after hours, things of that nature. So again, that's already an implementation taking place. So the real question becomes there is, does that further translate into both domestically and globally a reduction in cost for companies that ultimately enable them to pass on lower costs to the consumers or keep costs the same. And so that's something that's yet to be seen. So we'll look and see, will the inflation stay moderating and going down? If that takes place, that's going to help the bond market respond. The other piece of it is, looking at it from the commercial real estate sector, you also still have the distressed properties that are starting to signal and come into the marketplace. So again, I think that there's going to be opportunity that's no doubt a great availability for us and for you as investors, but also at the same time, it's got to be cautious and selective in that respect, and also done in a manner knowing that we don't see where interest rates are just going to be a factor in moving down quickly. So you have a blessed and victorious week, for this is the week God has ordained for you.